What's going on? What's going on, everybody? It is Atasha Watkins, your favorite realtor, and we are back again. It is Monday, so you know what it means on a Monday. It is time for the Monday Market Report, where we let you know what's going on in these real estate streets. We have some interesting things to talk about today. What everybody loves to talk about, we're going to get into a little bit about the mortgage rates, where we predict they're going forward, and the trends that we're starting to see in the market right now. All year long we've been talking about the year of fives, and we were predicting that the interest rates were going to hit at least high fives. And this just depends on a little bit about how the economy is going to go forward. We're in an election year as well, so it's tough to judge when we're in an election year as well. So let's see what the analysts are saying. The Federal Reserve influences mortgage rates but does not set them. At its March 2024 meeting, the central bank kept the federal funds rate unchanged and said it will keep an eye on economic development to decide what its next rate move will be. So this is an election year. I think that has some things to do with it as well. Inflation is still a little high, so those are some of the factors that's going to play into it as well. And this is according to NerdWallet. Mortgage rates are influenced by many elements, including inflation rates, the pace of job creation, and whether the economy is growing or shrinking. The Federal Reserve monetary policies is a factor too, and it's set by the Federal Open Market Committee. Okay, so just to clarify that a little bit, the committee has decided to maintain the target range of the federal funds rate at about 5.25 to 5.5. So they're staying steady. I think we're waiting to see how this year kind of plays out. We know inventory is still a little bit low, and even with these interest rates being whatever they are, because inventory is still low, we still have high demand. So. And of course, we know inflation is high as well, and we're trying to tackle a little bit of that as well. So this is one of the reasons why the Feds are still trying to maintain where the interest rates are. Current expectations are that the Feds will start to cut rates at some point between June and September, somewhere around summertime to the end of summer. I think hopefully we can hit those fives by that time period of June, September, just bring the interest rates down to about 5%. So we'll keep an eye on that, and we'll see where we're headed. We were in a mid sixes to about high sixes this year, depending on, different factors in terms of like what your credit score is and everything like that, who your banker is. And we know you want to go shop around those rates as well. Don't just take the first bank that you go to. At least interview 2 or 3 banks before you make that decision, because you never know what programs that you may qualified for. So these are the projections for 2024. We're coming out of Q1 right now. Fannie Mae 6.7, MBA 6.8, NAR. These are where they projected that the interest rates was going to be, and all three averaged out about a 6.77, where we think the interest rates was going to be. It looks like the average is going to drop in Q2. 6.7 Fannie Mae's predicting, MBA, NRA 6.0. So just an average score of all three of them for about 6.6. When we look at when we look at Q3, we see another drop as well. I'm still optimistic that we're going to hit 5 this year. That's my prediction. That's where I would love to see. I would love to see at least high fives this year. Just get a little bit more people into the market. But as we know, demand is still high. Demand is definitely still high. So this is just a chart just based upon the mortgage 30-year fix, demand based upon rate environment. So when we look at interest rates when they're in the mid to high sevens, buying is a little bit weak. When we move down to 7 to 6.5, we get a little bit more of that limited demand, which is weird because we're at this point right now. We're still seeing high demand, and that just goes to because remember what we looked at last week when we looked at the regional map, and especially in the New York area, inventory is still low. So although we're in that limited range between 6.5 to 7, because the demand is so high, because the demand is still high in the New York area because we have limited inventory. And we're gonna keep on saying that six to 6.5 to 6. We've touched these ranges over Q1. In the low sixes. That's good. And then when we get down to the fives, below 6 and 5 to 5.5, that's when demand is really, really, really strong. And again, there's different factors that's gonna play a part in the demand, but because inventory is so low, I think we're still seeing strong demand in this market, even though we're in those higher interest rates. Housing demand has been on a steady rise due to population, job growth. Through the actual timing of purchase will be determined by the prevailing mortgage rates and wider inventory choices. Again, we looked at this last week as well when we broke down on what the inventory is looking like in certain parts of the country, and we saw some increases in certain pockets. We saw increase in the inventory in a lot of places in the U.S. So we know that inventory is coming. We know that sellers have seen that. Look, the rates are what the rates are. You can't change them. You can't affect them. But if you need to make that move, you need to move. You need to move to somewhere for retirement. If you need to make the move in terms of space in your home, if you need to make that move in terms of downsizing, you just have to make that move. You just got to bite the bullet, because does the need outweigh your interest rates right now? And that's what's been happening over this past year or so, is that a lot of sellers has been on the fence because what they're looking at is the fact that they refinance into these interest rates where they're in the threes and the fours. And they're like, how can I make this move to a new house and justify mentally me paying a higher interest rate? And one thing that I like to tell a lot of my sellers whenever I'm taking a listing or anything like that, like, look, let's not worry about the interest rate. Let's worry about your monthly payment. You're selling this property, and we know, depending on when you purchase this home, over this last couple of years, we saw a lot of equity in these homes. And I've been saying that, and I'm going to continue saying that. We saw a decent amount of equity in this home. Let's sell this home, see how much we're going to get for it, and let's put down a larger chunk on this new home. And then that's going to bring down that monthly payment, because that's all that matters. And then when you look at it from that standpoint, when the rates do pull back, now you have that opportunity to go even lower with those interests with that monthly payment, because now we can refinance into a lower rate, or we can stay where we need to be. And remember, when you refinance into that lower rate, you can roll that closing cost into that mortgage as well. So just touch base with your lender, and they'll walk you through that. When you zoom out, affordability is still very, very low from a historical perspective. So when we look at the average interest rate, we're still in fairly good order. I think where a lot of people are missing the ball is that they're comparing what the rates were last year and 2 years ago, and they're comparing it to where it is now, and they're not looking at it from a historical standpoint. When we look at the average, we're not too far off the average interest rate. So I want you guys to keep that in mind. You know, I kind of feel, and this is my personal opinion, that those 2 and 3 interest rates are one in a lifetime opportunity. And like what one of my favorite lenders have always said to me, Peter Carlin, is like, look, the interest rates are dependent upon what's going on in the world. We know whenever we're in hard times, the feds tend to pull back to encourage spending a little bit as well. So, these are things that we just can't control. So it is what it is. Affordability by historic. When we look at 2023 is going to be that little blue line down there, and we look at that black line, we just got to see that we're right on pace. We're not too far off. And this is from 1990 to 2023, affordability historical low. Okay. And this is Natasha Watkins. It's been another Monday market report where we go through and we let you know what's going on in these mean real estate streets. And I'll keep you posted. I'll see you guys next week. It's Natasha Watkins. I'm out of here. Peace.